Hello and welcome to our latest Insider interview. Today in the studio I have with me Nicholls, who is Fund Manager of the Fidelity China Special Situations Investment Trust. Dale, thanks for coming in today.
Thanks, Kyle. Great to be here.
So Dale, it's been a challenging couple of years to be investing in China. One of the main headwinds has been the zero COVID policy. Now that that's been relaxed, are potential brighter times ahead?
I think absolutely. If you think about what's held the market back, I mean, there's a few things. Obviously, the regulatory storm that we've been through, what's going through in the property sector. But I'd say, definitely the zero COVID policy, the lockdowns have been a real constraint on just economic growth in general, and sort of the market as well. Just that mindset around that as well. So clearly, we've got through things pretty quickly, and I think from here the outlook looks pretty bright. I think China will be one of the few large economies that actually has accelerating growth this year in terms of economic growth. And likewise, probably accelerating earnings growth as well. And we're actually seeing earnings upgrades come through as well. So I think it's stacking up pretty well relative to a lot of other markets.
And have you been making changes to the portfolio to take advantage of the lower valuations that are on offer? Are there any sectors you pick out that you've been increasing exposure to, or any new companies?
Yeah, absolutely. So through last year, as you know, we saw a significant sell-off, sort of, record low valuations. So that threw up quite a few opportunities. And I think, those sectors that were impacted by the lockdowns were clearly, the ones that got very cheap. So, in the consumption space, that was definitely an area of increase for me. So when I think about sort of the changes in the portfolio over the last 12 months, actually consumer discretionary is probably the biggest area of increase, with the view that things had to open up. I think things have probably opened up faster and earlier than we expected, but I think the outlook for the consumer is clearly very strong. It will be the main driver of growth this year, and I think the prospects are pretty good. You've seen a real massive increase in household savings through this period, through the COVID period, and obviously people have been locked up for 3 years. So I think there's a lot of pent-up demand that can be released. I think clearly you need to see some bottoming in the property sector. So I think the mindset around property, obviously, the consumer in China has pretty significant exposure on their balance sheets to property. So I think if we see things start to bottom in the property sector, I think from a consumer confidence point of view, I think that the prospects are clearly strong in the whole consumption space. And then I think beyond that, you can look, to a sort of a broader economic recovery. So the industrials, and I think also particularly interesting would be the financials. If you think about basically the potential for increasing credit growth, improving credit quality, again, more regulatory clarity in some sectors, I'd say that's an area that's been a laggard, but I think the prospects in terms of fundamentals improving actually looks pretty good.
Could you give us a couple of examples of consumer stocks that you own in the portfolio?
I'm thinking of a company called JNBY, which stands for Just Naturally Be Yourself. So interesting name. But this is a company that does relatively high-end, kind of edgy apparel. So I guess in many ways, competing with some of the foreign brands, but doing a good job at that. Quite innovative company, a good track record of growing the business over time. So again, as things open up and people are heading outdoors more, I think there's good prospects for a recovery there, and you're paying quite a low multiple, sort of single-digit earnings for a business that has a good track record of growing over time, and should benefit from some recovery.
And how do the valuations of the companies that you own compare today to history for the trust?
Yeah, if you look at the sort of the over time, average valuations for the trust have probably been around 15 times forward earnings. And now we're probably in the sort of 11 to 12 times range for the trust. So kind of in line with the market overall. And that's, recovering from a bottom of probably closer to 8 or 9. So obviously we've had a pretty, a nice bounce from the bottom as sort of, prospects have improved. But, from a historical perspective, still reasonably cheap. So, there's I think still pretty good prospects in terms of that multiple potential to expand.
As you touched on earlier, one of the headwinds has been the regulatory changes to the technology sector.
Right.
And another area of concern is debt levels in the property market.
Yes.
What are your views on those two areas of concern?
Yeah, I mean, it's been, as you say, a really tough period for the property sector. I think it's important to keep in mind that, a lot of the correction is due to tightening regulatory policy. And now we're in the process where, a lot of those, that tightening regulation is actually being unwound. So I think, that continues. There's more potential for lower deposit rates, lower deposit levels on properties, and that sort of thing. So I think the prospects for things improving are actually pretty good. But you're right. I mean, if you think about, I'm not so concerned about the individual consumer, as we've talked about. The consumer balance sheet is actually in pretty good shape. Cash levels have picked up, but it's been a tough time for the developers, particularly the private developers. So I think it's important to be selective when you're looking at the market and really focus on the developers that have the strong balance sheets. And I'd probably favour the state-owned developers versus the private developers at this point in time.
As mentioned, it's been a tough short-term period. And if I took the time period from the 1st of February 2021 to the end of October 2022, the share price of the trust will be down 50%.
Right.
Does that sort of drawdown show the risks of investing in China?
You have to be honest, China's a volatile market. It tends to be, fairly driven by headlines, whether it's about economic growth, whether it's about geopolitics. It tends to be in the headlines, and the market, is volatile as a result, and sentiment can swing significantly. But, as you know, I'm very focused on individual companies, their ability to grow earnings, to realize and sort of create value over time. So as an individual investor focused on individual companies, that can throw up great opportunities. So, when the market does get, it is impacted by these headlines, that can create good opportunities. And, you've seen us capitalize on that, last year with the downturn. So, we actually put more money to work. We saw the gearing in the portfolio pick up. We've actually pulled that back somewhat with the recovery. But, I just say that volatility in the market is really what can create a lot of opportunities for the investor.
And does it also show that investors should be patient and think long term, particularly investing in a China-focused strategy?
Yeah, absolutely. It's important to have that long-term view. That's what we do when we look at individual companies. We think about the prospects for individual businesses over the longer term. So I think likewise, for investors, take the long-term view as we do.
Dale, thanks for coming in today.
Thanks, Kyle.
That's all we have time for today. You can check out the rest of our Insider interview on our YouTube channel, where you can like and subscribe. Hopefully, see you next time.